what's going on? Good morning. It's Saturday. It's Chase here at EVERBULLISH, the Stock Sherpa on YouTube. Beautiful day here in the Hill Country. Figured I'd make a video based on a conversation that I had with a good friend who is in more of a balanced allocation. He's not a trader. He's not interested in trying to make astronomical returns. And to switch up gears a little bit on the channel, I figured I would do a quick video on how to make a balanced portfolio that squeezes just a little bit more juice than what the average 60-40 S&P and Barclays Ag balanced allocation is going to get you, and certainly more than what your high fee wrap accounts will get you at a company like Fidelity or Schwab or Vanguard or Goldman or really anywhere else. And the answer is very simple. But first, let's revisit that song. That song was Have Whatever You Like by T.I. I know it is an old song, but it's a goodie. So Whatever You Like by T.I. And keeping on the theme of trying to use wordplay with the songs, we're going to talk about AT&T, which symbol is T. So I'm going to talk about AT&T today, as well as how to squeeze the juice out of a balanced portfolio very simply by using one simple mutual fund. I do it in the EVERBULLISH balanced portfolio. I hold AT&T in the EVERBULLISH balance as well as the EVERBULLISH dividend portfolios, and my customers are very happy with that because they're beating the market. But let's get right to it. So AT&T, real simple. The person I was referring to earlier, by the way, is my dad, who's a retired individual and is not often satisfied with a lot of the results of the performance of some of the stocks he picks. And I've been trying to tell him for a very long time, why don't you just buy AT&T? Why don't you just buy high dividend payers like ExxonMobil? So anyway, we got him in a dividend portfolio a couple of years ago. He's been very happy. So I wanted to pass that information on to you all, knowing that not everybody is a aggressive investor or trader like I am. So we're going to go to Fidelity. I'm going to show you a couple of metrics on AT&T, and then I'm going to talk about using convertible securities and how they operate inside of a balanced asset mix. So let's get to it. All right, so when it comes to a dividend portfolio, one of the first things I look for, a lot of people look at dividend increases year over year. I don't care so much about that because I believe that using the cap-in model, it's already priced in. I also think that for super high quality dividends, you're actually paying a little bit more, the same as you would be when you're buying a AAA rated bond or AA rated bond or any type of ultra high secured debt instrument. So I like to look for higher than a 5% yield. To me, it doesn't make sense not to take 2 or 3 days worth of gains in the market like I've been able to scalp in my normal portfolios and waste it by buying a dividend stock that's going to pay you 2 or 3%. That's why I don't call Apple a dividend paying stock. Yes, I know it pays a dividend, but it's not enough to get me out of bed, basically. And I don't think it should be for most investors. A lot of investors have settled for very, very, very low dividend yields for a very long time. And I understand the risk reward principles, but also think that you ought to be able to do better. So, you know, when you filter out a company like AT&T, they're a utility service, they're a telecom service, they are needed, they are population based. I don't see people not needing some type of cellular service in the next 2 to 5 years. It is a competitive environment. It's also a little bit watered down. And then the biggest thing is it's on the precipice of the 5G space and 5G, and I'm sure 6G will come out, and 7G and 11G and 50G. So right now they're trading at 31. They're up over 10% this year, and they pay a forward dividend yield of $2.08 a share. So that's just under a 7% dividend yield. No reason not to buy a 7% dividend yield in a company as stable as AT&T is, particularly with the rotation of value that we're seeing, especially when interest rates start getting volatile and people start going, well, tech stocks are going to get crushed. Well, this isn't necessarily a tech stock. Yeah, it has some exposure to tech space. They sell Apple products through their client base and their services, but they're not really a tech company. There is, simply put, this is the normal utility phone company play of the old days, and we're getting a 6.5%, 6.63% yield on a 10% earning stock. Even if it's down 10% the rest of the year, you're still getting that income. I don't think it will be. I think it's going to continue. Mid, short, and long-term outlook is good. It just gapped up, which is a good thing. And I believe that just genuinely, again, not to be overly concentrated in certain stocks, particularly in a dividend portfolio. I only hold 11 positions in my dividend portfolio, the EVERBULLISH dividend and income portfolio, also known as the old man dividend payer portfolio. But yeah, in all honesty, I don't see any reason to hold Verizon and AT&T and whatever other mobile services are out there. Just pick one. Pick the one with the best yield and the best outlook and a differentiated client experience, and hold it. So there's my AT&T pick for the day. There are my thoughts. Remember, 6.65%, 6.63% dividend yield, and it does pay quarterly. So we're going to shut the door on that. Now I'm going to tell you how to build a better balanced portfolio. So historically speaking, a balanced portfolio is between 50 and 60% stocks and 35 and 40% bonds, with roughly 5% cash alternatives. I don't hold any cash alternatives. I don't believe in it. It doesn't make any sense to waste 5% on my portfolio. But that's kind of the standard in most brokerages, and particularly Fidelity, Vanguard, Schwab. That's what they're going to do for the average, say, 65-year-old client. They may tweak it one direction or another, but for the most part, that's what a balanced portfolio is. Here's the problem. If you were to pull up AGG, which is the Barclays aggregate, which is named after Barclays Bank, and this is the standard for what the 40% of a balanced portfolio would be invested in. So what most folks, particularly indexers, don't know is that the Barclays aggregate is like 90-something% AAA rated bonds. And what happens to AAA rated bonds? Well, they give you bad yield, as I mentioned before in this video, because they're such high quality that there isn't any real risk of debt or credit loss. But they also don't give you a lot of gain because they're not taking any risk. Well, what I like to use instead is convertible securities. So FCVSX. This is an old Fidelity trick that I learned in my time there. So shout out some of my old mentors that taught me this one. But a convertible security is essentially an alternative to a stock or a bond that allows you to convert your instrument to a bond or a stock. And the theory behind it is that when interest rates get super volatile, they act more like stocks, like right now. So when the market's going up, they continue to go up a little bit more, but when the market is down or volatile, they act more like bonds, and they're a little bit more resistant, and they provide some portfolio buoyancy. So basically, this is a mutual fund that holds those type of instruments. It has a very high turnover because it is actively managed versus passively managed. And this is what I use in the EVERBULLISH balanced portfolio instead of just holding 40% in a 2% yielding total bond fund. I mixed this with another bond fund. You'll have to buy it to know what that bond fund is if you care to check that out. Go to everbullish.com portfolio store. But let me go over some returns and some results with you, and I think that this will show you a little bit more. So looking at the chart back there, we can see how stable it is. But we can also see that this year, as the market has gone pretty much straight up and interest rates have stayed mostly stable, they have climbed a little bit, but not enough to put a dent in the performance of a portfolio that was only allocated 40% to bonds. So to me, that aspect is wasted. So I'm sure I've driven that point home. But the convertible securities fund is up 7.6% annualized. That's this year. So this year it's up 7.6%. The 1-year return is 68%. The 3-year, and this is cumulative now, the 3-year, actually that's annualized. The 3-year is 23.21%. The 5-year is 17%. The 10-year is 10%. So I'm not positioning this as a complete alternative to bonds, but I am saying that if you're going to have 40% of your assets to smooth the ride of a stock portfolio, why not have it be a little bit more nimble than the average shitty bond fund? Straight up, that's what it is. So anyway, checking that out. I think that that's a great way. I'm giving away a lot of secrets here, but I think that's a great way to kind of uplift the consciousness of all the investors out there that are wondering why their balanced portfolio just gives them 7% annualized over 10 years and they don't really know much about what's inside of it. Or if you are one of the Dave Ramsey, Susie Orman sheep that just thinks that you should buy a Vanguard fund and the Vanguard S&P, the Vanguard Barclays Ag, and then a cash alternative, that's what you're missing out on your wasted money. And I'm here to tell you the truth. And the Sherpa is going to take you to the top of the mountain. So anyway, FC, VSX, and AT&T, that's what we learned today. Feel free to check them out. Feel free to holler at me in the comments. I'd love a subscribe. I'd love a like. Check out the EVERBULLISH.com podcast, the EVERBULLISH 1 podcast on all podcatchers. Go to EVERBULLISH.com and sign up for the newsletter. I'm Chase, also known as the Stock Sherpa, also known as Chase at EVERBULLISH. Let's get rich. Let's go to the top of the mountain. I hope you enjoy your Saturday. Check out AT&T and Fidelity Convertible Securities Fund. All right. Have a great day.